Hello VIFHEians. In this video lecture, we will be discussing the credit risk, the credit migration and the yield curve. Now these things are relevant when you are valuing a bond or when a lender is providing a loan to a company. Now let's discuss these terms one by one. The first thing that we will discuss is the credit risk. What is credit risk and how can one define it? When we talk about credit risk, it is also known as default risk, and it is the risk which is undertaken by the lender that the borrower will default either on interest payments or on the repayment of principal on the due date or both. So basically, credit risk is a risk that the lender undertakes, and it is the risk that the borrower may not be able to make the interest payments or the principal amount that has to be repaid, or both of them. Whenever you are providing loan to a company or to someone, there is always such type of risk involved that the borrower may not be able to pay. Therefore, there is a link between the credit risk and at what interest rate the loan should be provided. Generally, companies having higher credit risk will have to compensate the lenders in form of higher interest payments, and hence it is very crucial for the lender to evaluate a company's credit risk before providing the loan, because he is taking a risk and the lender has to evaluate that risk. Okay, so how does this happen? In real life, there are various different credit rating companies which assess the credit rating of different companies. So these companies provide a chart or a ratings table, and that rating table demonstrates, or that rating table reflects the amount of credit risk involved in a company. These rating agencies provide information on creditworthiness of a company to a potential investor before they make any sort of investments. Practically, there are various credit rating agencies such as Standard & Poor and Moody's Investor Services, and they provide a list of credit rating for different companies. The credit rating used by Standard & Poor, one of the credit rating agencies, look like something like this, which I will demonstrate over here. They evaluate the highest quality and zero risk companies as AAA. They rate them AAA. AAA is the highest quality, zero risk companies. After that, the second type of companies are rated as AA. The AA companies are high quality. After that, we have A-rated companies, and these A-rated companies are upper medium grade quality. And this list keeps going on as BBB, BB, B-rated, where triple B are medium grade quality, double B are lower medium grade quality, B graded are speculative, and then we have triple C, which is a poor quality, double C, highly speculative, and C, which is lowest grade quality. So these are different types of ratings which Standard and Poor, one of the credit rating agencies, offers, and on this basis they evaluate a company, where C is the lowest rated company and AAA is the highest rated companies. Now there are certain factors which these credit rating agencies take into account when they give this sort of ranking, and the factors which have shown particular correlation with the likelihood that a company will default on its obligation are: number one, the magnitude and strength of the company's cash flows. Generally, the higher the cash flows, the less risky the company will be. However, if a company has difficulties in cash flows, it will be rated lower. Second thing is the size of the debt relative to the asset value of the firm. Again, if a company has low amount of debts as compared to the size of the assets value, it will have a higher rating. However, higher debts will mean more gearing, and this may be problematic in terms of repaying the interest and the principals, and therefore the company will be rated lower. The third key factor that will be considered while rating companies is the length of time the debt has to run. So these are certain factors which a credit rating company will take into account while giving a particular rating to a company, while rating a company between AAA and C, and these ratings are from Standard and Poor, which is one of the credit rating companies. Different credit rating companies evaluate companies based on various different grades as issued by them. So basically, credit risk, if you recap, is the risk that the lender may not be able to recover the interest payments and the principal from the borrower. Now we will move on to the next term, which is credit migration. So now let's discuss what credit migration is.